China is on track to set a new record for trade surplus this year, intensifying deep conflicts with many major countries. Worldwide projections indicate that China will achieve an impressive trade surplus of up to $1 trillion by 2024, which could shake the global economy. Chinese exports are spreading across markets in Asia, the United States, and Europe, exacerbating the already severe global trade imbalance. This substantial trade surplus not only heightens tensions in international markets but also exposes many nations to the risk of trade conflicts, tariff wars, currency disputes, and disruptions in supply chains. China's trade surplus is not only a sign of a rapidly rising economy but also raises concerns about the potential emergence of a global trade storm. In the first 10 months of 2024, China's merchandise trade surplus soars to $785 billion, marking a 16% increase compared to the same period in 2023. If this trend continues, the figure is expected to reach $1 trillion by the end of the year. The current trade surplus accounts for 5.2% of China's GDP, the highest level since 2015 and significantly above the average of the past decade. October 2024 alone recorded the third largest monthly trade surplus in history, trailing only the record set in June. China's export strategy, where companies skillfully combine lower prices with higher volumes, has substantially increased the volume of goods exported despite a decline in export prices. China has substantially increased the volume of goods exported, leveraging its vast efficient manufacturing base and stable supply chains to overcome logistical and supply chain disruptions faced by many other nations. However, weak domestic demand has also played a significant role in China's record trade surplus. Significant changes may be anticipated as Donald Trump assumes the U.S. presidency next year, with Robert Lear, the architect of the previous trade war with China, expected to return to a leading trade role. China's trade surplus has been a significant issue due to the global economic slowdown and shifts in consumption patterns. The combination of strong exports and weak imports has created a perfect storm for China's trade surplus. However, this growing trade imbalance has also generated significant global economic repercussions. Concerns and potential retaliatory actions from China's trading partners are mounting in response to this growing trade imbalance. The return of Donald Trump as President of the United States poses a clear threat of imposing new tariffs on imports from China. The Trump administration is considering tariffs of up to 40% on Chinese goods, citing concerns over unfair trade practices. This move could significantly impact China's export flow to the United States, which accounted for about 16% of its total exports in 2022. China's economy is currently in a vulnerable state due to a prolonged slump in the real estate sector, high debt risks, and weak domestic demand. Experts predict that high tariffs could increase domestic inflation in the United States. In response to these challenges, China has stepped up economic stimulus measures since late September to boost domestic demand and offset the decline in exports. Analysts believe Beijing needs to implement additional support measures to achieve its growth target of around 5% this year. Not only the United States but also many other countries, especially in Europe and South America, have strengthened tariff barriers against Chinese products such as steel and electric vehicles. This reflects growing concerns over China's dominance in global trade as local manufacturers face the threat of recession. Western media continues to emphasize the economic risks and growing global influence of China, which presents an unprecedented challenge for many countries as it is not only an economic competitor but also a comprehensive rival in both trade and technology. China's State Council announced that it would maintain financial support policies to boost trade, stabilize the economy, and create jobs. One of China's key strategies is the stable management of the yuan to maintain its export advantage. However, if China decides to devalue its currency to counter U.S. tariffs, it could trigger a wave of currency devaluation globally. China is pursuing a clear development strategy focused on reducing its reliance on foreign technology and imported goods. This strategy places particular emphasis on sectors such as semiconductors, artificial intelligence, and clean energy by promoting research and development. Investment in high-tech industries, particularly green energy, has become a core element of this approach, strengthening China's status as one of the world's leading producers of solar panels and electric vehicles while meeting the growing global demand for sustainable energy solutions. China's trade surplus has significantly impacted global economic figures and supply chains, leading to a shift in diplomatic relations and forcing countries to reassess their economic strategies. Many companies have begun diversifying their supply chains to reduce dependence on China, driven by trade tensions and the effects of the COVID-19 pandemic. The future remains uncertain, with the potential return of former President Donald Trump to the White House potentially escalating the situation. However, China faces significant internal challenges, including an aging population and shrinking workforce, which are placing substantial pressure on the economy. The debt-driven growth model and potential risks from the real estate market raise concerns about long-term sustainability, which could affect China's ability to maintain its export dominance in the long run. China's trade strategy not only generates profits but also reflects a vision for a new global economic order through currency stability, technological investment, and the establishment of partnerships worldwide. China's economy has grown by 5.3% this year, exceeding initial forecasts, thanks to a focus on manufacturing. However, China's growing dominance in these sectors has heightened tensions with Western nations, particularly amid concerns over reliance on cheaper green energy solutions from China. Russia's actions have also captured international attention, with President Vladimir Putin canceling $23 billion in debt owed by African countries and promising free grain to at least 6 nations in the region. This move is not just a gesture of goodwill but also a strategic maneuver reflecting Russia's ambition to reshape the global economic landscape by leveraging its abundant resources and flexing economic policies. Russia's debt forgiveness not only alleviates the financial burdens of African nations but also opens up opportunities for development with freed-up financial resources, allowing them to invest in education, healthcare, and infrastructure. This step also reduces dependency on traditional financial institutions like the International Monetary Fund, (IMF), and the World Bank, which have long been criticized for their stringent lending conditions. The decisions and actions of today will lay the foundation for decades of future development and competition. Russia's debt cancellation initiative for African countries has gained significant attention, with agreements to forgive substantial debts borne by these nations. Russia has agreed to write off $3.5 billion of Angola's debt arising from weapons purchases from the Soviet Union, $5 billion of Ethiopia's debt, $5.7 billion of Algeria's debt, and $4.5 billion of Libya's debt. Beyond debt relief, Russia has pledged to provide free grain to several African countries facing severe food crises in the past 24 hours. This move is seen as a counterbalance to Western accusations that Russia's withdrawal from the grain deal with Ukraine is endangering Africa's food security. Russia's strategy extends beyond debt relief and humanitarian aid, encompassing development funding and building economic and political ties with Africa. This decision carries not only economic significance but also contributes to shifting global perceptions of Africa's role in the international financial system. Many African nations have been viewed as debtors in the international financial system, but this initiative could change that narrative by giving these nations stronger bargaining power in global economic forums. Russia's debt cancellation initiative comes as Russia intensifies efforts to build alliances beyond Western influence. Putin emphasized that Russia's focus on Africa is part of a broader strategy to expand its geopolitical influence, aligning with the new phase of Africa's economic development mentioned by African Union chairperson and former Egyptian President Abdel Fattah. Professor Benedict Arama, president of the Axe Bank, emphasized the commitment of Axe Bank and the Russian Export Center to doubling trade volumes within 2 years. Axe Bank will play a crucial role in providing guarantees and programs to mitigate perceived risks, strengthening international trade, and fully leveraging the benefits of debt forgiveness while shaping the future of the global financial system. Russia's decision to cancel debts raises profound questions about the global financial model, as a multipolar global financial system with multiple economic hubs and diverse financial models could create more opportunities and favorable terms for developing countries. Traditional institutions like the IMF and World Bank are under pressure to reform and adapt to these changes. Competition from countries like Russia may drive positive adjustments in their operations, enabling developing nations to access financial resources under more favorable conditions. The impacts of this decision will not be limited to a few years but may extend for decades, altering the balance of global economic power and leading to more equitable development or stronger reforms in traditional financial institutions. In Q4 2023, BYD surpassed Tesla in battery and electric vehicle sales, solidifying its position as a leader in the industry. In contrast, Tesla, the world's largest EV market, has been overshadowed by domestic manufacturers like BYD due to competitive pricing strategies and superior production capabilities. BD is not only focusing on its domestic market but also aggressively expanding globally, with a 24% year-over-year growth in exports. BYD's continuous innovation and adaptability have put Tesla and other automakers under increasing competitive pressure. BYD's success is a testament to overcoming stereotypes and leading in a volatile industry, marking a new chapter in the global electric vehicle revolution. Both the financial and technology sectors are witnessing groundbreaking changes, from efforts to enhance Russia-Africa cooperation to fierce competition in the electric vehicle industry. The world is experiencing the rise of new power centers, shaping a future filled with both promising opportunities and formidable challenges.